fair, microfinance institutions have not tended to be the best potential delivery channel. The hope was there because of this ability to onlay microinsurance on top of what microfinance institutions are doing already. The problem has been, although there are several microfinance institutions that do really good microinsurance and really are client-focused in what they're doing, the problem is that what we create is a system of mixed incentives. The MFI has two incentives. It has the incentive to improve the quality of product for clients and improve their well-being. It also has the incentive to generate cash. And so too often what we see in microfinance is that the institution is interested in what I call the top-tier benefits, right? They want the commissions, and they want to protect their portfolio from the risk of death of clients. So these are two very quick, easy cash benefits that they can see. What they don't see as often is the benefit of what I call the second-tier benefits, the benefit of if my client has health insurance, then when their kid gets sick, they'll go to the hospital, they'll go to the doctor, they'll get taken care of, it'll be quick, there won't be a disruption in the business, there won't be a decapitalization of the business. The woman will not be, or the client will not be in a worse position financially, and then they'll be able to work with me as the microfinance institution more effectively and more efficiently. We don't have these gaps in the interaction with the microfinance institution. If the woman has insurance for her husband, life insurance, and the husband dies, if the product is good, it will keep her again from having these financial gaps in her business with the microfinance institution. So for me, there's dramatic benefits, even more so on the second tier than on the first tier. But what microfinance institutions tend to focus on is this first tier. And so what we need to do is work with them to try to get them to understand more and more that there's a much broader benefit that they can have by moving to recognizing the benefits of this second tier. Now, there's a complication. The complication is that it's very easy for microfinance institutions to say, let's offer credit life insurance. Then they know they can get a commission, they know they can protect themselves from the death losses. And it's very simple, they can make their clients purchase it. They can make this a mandatory product. Once we start to move to products like health insurance for your children, it's very difficult to make a legitimate argument that if you borrow for working capital, you must buy health insurance for your child. And so now we move into the realm of voluntary products, which then require more work in terms of selling, more administrative difficulty in terms of having some clients purchasing and some clients not. And all of these are being worked on in terms of making these more efficient. How can we use, for example, financial education tools to educate the market as a whole so that they're more receptive? How can we create electronic structures so that those who are buying buy efficiently, those who are not affected as much, so we can increase the efficiencies? There's a lot of work to do here, and even though microinsurance has really grown substantially over the last several years, we're still very much in the nascent phases. We don't even talk about best practices yet. We still talk about good and bad practices because we don't know yet what the best practices are. There's lots and lots of examples of different kinds of insurance, different delivery channels. We talk about delivery channels that include cell phones and churches and retail outlets and funeral homes and MFIs and a whole array of these different delivery channels, all trying to figure out how we can make this work better and hit what I estimate to be a market of about 3 billion people. If we think about accessing 3 billion people, certainly microfinance institutions are not the mechanism. The mixed market says that there are 75 million people that are getting credit. If we just look at those 75 million people plus their families, that's only what? 450 million people? That's only a sixth, 15% of the total market that I think is there. We have to find different delivery channels. We have to figure out how to make them effective. But this isn't an easy question. Okay, and I don't mean to pretend that it is. This is a difficult question, and it's a challenge, but there are lots of institutions, lots of organizations, commercial and non-commercial, that are involved in this business. One of the things that's been a thrill for me in microinsurance is that we have such interaction with the commercial institutions. When we look at microfinance, it took us, 25 or 30 years before we had substantial commercial interaction directly in microfinance. When we look now, right from the start, we've had commercial insurance companies here. And yes, we have to help them figure out how to do better products. Yes, we have to help them figure out how to manage their efficiencies and understand this market, but they're there. And so we have this huge resource so that I believe microinsurance can grow much, much faster than microfinance ever did and can have a much greater impact in helping people protect their gains, whether they get it from microfinance loans or they get it from their own businesses or their families or wherever.